Most people assume power is visible. Governments, armies, presidents, parliaments, flags, speeches, elections. But the deepest forms of power are often quiet, procedural, and deliberately unremarkable. They exist not in headlines, but in systems, in routines, in institutions that rarely need to explain themselves because their authority is assumed rather than questioned. One of the most influential of these institutions sits in a modest European city, far from global capitals. Basel, Switzerland. A place better known for pharmaceuticals and banking discretion than global dominance. On a calm street near the Rhine stands a tall, functional office building. No crowds, no protests, no ceremonial guards. Yet decisions shaped inside this building ripple through every currency, every bond market, and every national balance sheet on Earth. This building houses the Bank for International Settlements, commonly known as the BIS. Unlike central banks, the BIS does not issue currency. Unlike governments, it does not pass laws. And unlike international organizations, it rarely speaks publicly. Its power comes not from visibility, but from coordination. It exists to serve central banks themselves, functioning as their meeting ground, settlement platform, and financial intermediary. The BIS was founded in 1930, officially to manage German reparations following World War I. But from the beginning, its role expanded far beyond that mandate. It became a neutral financial hub, where central banks could interact away from political pressure, legal constraints, and public scrutiny. Over time, this neutrality became its greatest strength. Central banks are unusual institutions. They are national in mandate, yet global in consequence. Their decisions spill across borders instantly. Interest rates set in Washington affect housing prices in Asia. Liquidity injections in Europe influence commodity markets in Africa. The BIS emerged as the place where these realities could be acknowledged and managed collectively. Every 2 months, governors from the world's most powerful central banks gather in Basel. These meetings are closed. No press conferences, no transcripts, no voting records. Participants describe them as frank, technical, and informal. But their outcomes shape coordinated responses to crises, currency instability, and systemic risk. At the center of these conversations sits a subject older than modern finance itself: gold. Gold occupies a peculiar position in the global system. Officially, it no longer backs currencies. Since the early 1970s, the world has operated on fiat money, currencies supported by trust and state authority rather than metal. Yet gold remains on central bank balance sheets. It is still held, guarded, and reported sometimes vaguely by institutions that insist it no longer matters. This contradiction is where the story begins. For centuries, gold was money. It settled trade imbalances, anchored currencies, and imposed discipline on governments. Wars were financed by it. Empires rose and fell around access to it. Even as paper instruments developed, gold remained the ultimate reference point, the asset of last resort. The 20th century was an attempt to escape gold's constraints. After World War II, the Bretton Woods system linked currencies to the US dollar and the dollar to gold. This created stability, but also tension. As global trade expanded, so did the need for dollars. And as dollars multiplied, the gold backing them became increasingly strained. By the 1960s, the imbalance was clear. The United States had issued more dollars than it could realistically redeem for gold at the official price. Foreign governments noticed. Confidence began to erode. Rather than openly revaluing gold or restructuring the system, policymakers attempted management. Through coordinated central bank actions, gold sales were used to stabilize markets and maintain official price targets. These efforts delayed the inevitable, but at a cost. Physical gold flowed steadily out of official vaults. When the system finally broke in the early 1970s, the response was decisive. Gold was removed from its formal monetary role. The dollar became fully fiat. Exchange rates floated. The era of modern finance began. At least, that was the public narrative. Behind the scenes, gold never disappeared. It simply changed function. Central banks did not sell their gold en masse. They retained it. Some increased their holdings decades later. Gold continued to be used in swaps, leases, and settlement arrangements between institutions. The metal no longer defined currency values, but it remained a stabilizing asset, one that could be mobilized quietly in moments of stress. The BIS played a key role in this transition. It provided the infrastructure through which gold could move between central banks without public attention. Titles could change without shipments. Obligations could be settled without announcements. Gold became a silent instrument of confidence management. This arrangement suited everyone involved. Governments gained monetary flexibility. Central banks retained an anchor. Markets were spared destabilizing signals. And the public was told gold was obsolete. Yet actions spoke differently than words. Throughout the late 20th century, central banks remained net holders of gold. They coordinated sales carefully to avoid price disruption. They reported holdings infrequently and sometimes ambiguously. And when emerging powers began accumulating gold in the 2000s, they did so with minimal transparency. Gold had become a shadow asset, not central to the narrative, but central to contingency planning. And nowhere was this dual reality more evident than in the structure of the modern gold market itself. The contemporary gold market is divided into two layers that rarely intersect in public discussion. The first is the physical market. Bars, coins, vaults, refineries, transportation. This is the gold people imagine: heavy, tangible, finite. The second is the paper market. Futures, contracts, options, exchange-traded funds, and over-the-counter derivatives. This market determines price discovery, yet often operates independently of physical supply. Most gold trading occurs in the second layer. When an investor buys a gold futures contract, no metal changes hands. When an institution trades gold exposure through derivatives, no vault is opened. These instruments are settled financially, not physically. They rely on confidence that delivery could occur if required, but rarely test that assumption. This structure creates efficiency, liquidity, and leverage. It also creates fragility. Because paper claims can be created far more easily than physical gold, the volume of claims can vastly exceed available metal. This is not inherently fraudulent. It is a feature of modern financial markets. But it introduces risk when confidence weakens. During periods of stress, the demand for physical gold rises. Not exposure, but possession. Not price appreciation, but certainty. This is when the two layers strain against each other. Historically, central banks have acted to prevent this strain from becoming destabilized. They lease gold to bullion banks, increasing apparent supply. They engage in swaps that provide liquidity without altering reported reserves. They coordinate messaging to calm markets. These actions are legal, disclosed in aggregate, and framed as stability measures. Yet their cumulative effect is to smooth price signals that might otherwise reveal deeper imbalances in currency systems. Critics argue this suppresses gold's role as an early warning indicator. Defenders argue it prevents panic. Both views have merit. What is clear is that gold remains embedded in the architecture of global finance in ways rarely acknowledged publicly. Central banks continue to treat it as a reserve asset. International institutions maintain gold on their balance sheets, and coordination around gold continues through established channels. The BIS is central to this coordination, not as a conspiratorial actor, but as a facilitator of technical operations among peers. Its strength lies in discretion. It was designed to function beyond political cycles, beyond media narratives, beyond electoral pressures. This discretion has drawn criticism, particularly regarding transparency, but it has also allowed rapid responses during crises, from currency swaps to liquidity backstops. The question is not whether the system exists. It clearly does. The question is how it will behave under unprecedented strain. Since the turn of the millennium, global debt has expanded dramatically. Sovereign, corporate, and household obligations have reached levels previously unimaginable. Monetary policy has grown increasingly unconventional. Negative interest rates, quantitative easing, balance sheets measured in trillions. In this environment, gold has quietly regained attention. Central banks that once sold gold have become buyers. Emerging economies have diversified reserves away from single currency exposure. Geopolitical tensions have reintroduced sanctions risk into reserve management. Trust once assumed has become conditional. Gold addresses these concerns in a unique way. It carries no counterparty risk. It cannot be frozen digitally. It does not depend on a payment system. It exists outside political alignment. This does not mean a return to a gold standard. That era is unlikely to re-emerge, but it does suggest that gold's role as a strategic reserve is evolving rather than disappearing. The public conversation, however, remains largely unchanged. Gold is discussed as an investment, a hedge, a commodity, rarely as a monetary asset still actively managed by the very institutions that claim it is obsolete. This gap between narrative and behavior is where misunderstanding arises. Gold does not need to control the system to matter. It only needs to exist as the final reference point when trust erodes. That alone grants it significance. And significance, when understated, often becomes power. Every financial system rests on belief. Belief that obligations will be honored. that currencies will retain purchasing power, that institutions will function as expected. When belief holds, systems endure. When it weakens, alternatives gain appeal. Gold persists because it does not rely on belief in institutions, only belief in its scarcity and acceptance. This is why it has survived every monetary transformation in history. Not because it dominates daily transactions, but because it remains when structures change. The modern financial order is complex, adaptive, and resilient. It has weathered crises through coordination, innovation, and intervention. But it is also increasingly centralized, leveraged, and dependent on confidence. Institutions like the BIS exist to manage this reality, to reduce volatility, to prevent fragmentation, to coordinate responses before crises become collapses. Their secrecy is not accidental, it is structural. Transparency calms democracies. Discretion stabilizes markets. The balance between the two is always contested. For individuals, the lesson is not fear, but awareness. Gold is not a prophecy. It is not a guarantee. It is not an escape from economic reality. But it is a signal one that institutions continue to respect, even when rhetoric suggests otherwise. Understanding this does not require rejecting modern finance. It requires recognizing its foundations. The systems that govern money today are built on layers, some visible, some not. Gold exists in the deepest layer, rarely touched, quietly maintained, not because it controls everything, but because when everything else is questioned, it answers without speaking. That is why it endures. And that is why, even in an age of algorithms, digital currencies, and instantaneous markets, a metal buried in vaults still matters. Not as a relic, but as a reminder. If you want, next I can.